Hi, welcome to Forex in 4. I'm Mike Conlon for FXEDU, and in the next 4 minutes, I'm going to show you the highlights of where the action is in today's Forex market. So let's get started.
Good morning. Today is Wednesday, October 27th, 2010. This morning I'm talking about the Bernanke playbook. And what I mean by that is that Bernanke and his pals there are sitting there saying, we have ways of making you consume. And it's sort of, the idea is that they're trying to get the economy going through any means necessary, okay? And the way that they appear to be trying to do this is through inflation. So, they're trying to control how the economy functions, okay? They are not willing to allow the free markets to function. So what they're trying to do is orchestrate a stable economy. And how are they planning on doing this? Again, the answer is inflation. So, next week's FOMC meeting, it's all but a foregone conclusion that we're going to see further quantitative easing. All right, but the question remains how much. Now, most recently, our buddies at Goldman Sachs, they came out and said that further quantitative easing could be as high as $4 trillion. All right, that's trillion with a T. All right, now nobody in their right mind is actually expecting that much. Right now, the consensus seems to be around 500 billion. All right, so that's 500 billion with a B. All right, for a second there, I was getting a little bit concerned. All right, but hyperbole aside, $500 billion in quantitative easing. Just think about that number. It's just essentially money printing right there. And what's that's going to do is that once that money hits the economy, that's going to cause inflation. And because we've had this quantitative easing too on the table for some time, we're already starting to see inflation. All right, I just saw figures that said gasoline went up 15 cents last week a gallon. All right, even though we're past the summer driving season where demand is less. All right, now we've got physical commodities; those are higher. We got the grains, corn, beans. I think wheat was lock limit up for 5 days in a row most recently. All right, and the people are saying that food costs could rise by almost 20% or more if we get these numbers in the quantitative easing. So that's what's happening here in the U.S. Now let's talk about what's happening abroad. All right, in all these developing countries, they've got rampant inflation. Okay, because what's happening is that cheap money here in the U.S. is flowing to these hot countries. Okay, and people seeking yield and appreciation. All right, there's no growth here in the U.S., so why would you take the money and invest it here? No, you're gonna chase the hot money overseas. So they've got inflation around the globe. So why is this the desired scenario? Well, because it's going to cause you to consume today. All right, because now you're going to be afraid that prices are going to be higher tomorrow. All right, if you know that there's going to be inflation and prices are going up, now you have to buy today. So boom, all of a sudden they've got instant demand. All right, and also, the consumer represents some 70% of the U.S. economy. So if consumption increases, the logic is that the economy is going to do better as well. However, is that necessarily going to be the case? I don't think so, because what that's going to do is it's actually going to create a crisis of confidence, and even though stuff's going to be higher, people are only going to stick to the necessities. They're going to pare back, what have you. Okay, but as housing prices start to go up, okay, once everyone gets foreclosed upon, all right, now people have to rent. Well, now that there's more demand for renters, rent prices are going to go up. Okay, if we get inflation, rents are going to be higher. It's now going to become cheaper again to try and own a home. So now they're hoping to get the housing market back going again, because now there's going to be demand for people to buy homes. What that's going to do is that takes the foreclosures off the bank's books, and then voila, the banks can go back to profitability. They can go back to paying themselves huge bonuses, and meanwhile, we've got this humongous tax bill out there looming over everyone's head. So that appears to be what they're planning to do. Now, is this going to work? Well, I got to tell you, I don't think so, because it's sort of like fool me once, shame on me; fool me twice, shame on you. And I don't think anybody's buying it this time around. All right. Now, what's going to happen is that, they say, there is no inflation. Let's just strip out food and energy from the inflation figures, and we can show everybody that there's no inflation. So even though prices of milk is going up, gasoline's going up, we strip out food and energy. I mean, after all, who really needs those to begin with? Okay, you strip that out, and then no, there's no inflation. All right. Meanwhile, the unemployed are still unemployed. All right. You have more people have to hit the public dole to get food stamps to be able to afford food. All right, and now the government is controlling even more and more of people's lives. All right, and the last side benefit of this is that now the U.S. government, now that our dollars are worth less, meaning less, not worthless, but you can take it either way, they get to pay back all of their debts and their IOUs with worthless dollars, basically. So that solves the deficit problem right there. So that's what we've been seeing. Now the dollar's been higher as of the last 2 days because people are starting to say, wait a second, okay, they're not going to actually go $4 trillion in quantitative easing, are they? No, it's going to be about $500 billion. So that's okay. That's become a case of it's not as bad as it could have been. So that's why we're seeing some dollar strength. Okay, in some other news, we're also seeing that in Australia, CPI figures came in slightly lower than expected, all right, which shows that indeed there is no global inflation, although, they do have decent CPI growth of around 2.8%, so just keep that in mind. But you can see here on the chart, 2-hour chart, I showed you just double top yesterday, right ahead of parity with the dollar. That held, all right, bad CPI. The Aussie's lower, could retrace back to this 95.5 cents level here going forward. Just want to show you the euro. Euro's lower as well. The anti-dollar status of the euro is pushing it here, but we're in the range right now, about 136.5 to 141.5, and I expect we're going to trade that range until next week's FOMC meeting on Wednesday. Okay, we got the pound. Pound is holding up surprisingly well. Okay, we're just sitting above 158 right now. 157.5 looks about support. Okay, and lastly we've got dollar yen. Okay, dollar's been strengthening against the yen now. We hit the new 15-year highs, 80.5. They started jawboning about the intervention, and all of a sudden now we've got dollar strengthening. So looks like if we can stick up in these ranges, we're going to avoid yen intervention for some time. And I just want to show you lastly, who's newest to the intervention game? Well, Canada just came out and said, hey, if there's a problem with our currency, it may affect our economy, so we may have to go in and do market operations as well. So Canada's now getting into the intervention game. So, as you can see, bad behavior here in the U.S. Is really causing a lot of these other countries to sort of, take on these defensive roles, defend their currency weakness, as, the dollar's kind of been ruling the roost, so to speak. Now, it's really a good thing we had this G20 meeting last weekend, and they came away with all these solutions, because without it, I don't even know where we'd be. What actually did come out of that, who knows? But the Bernanke playbook is causing countries around the globe to do a lot of things that they otherwise might not do. Okay, so this all brings us back to this Fed meeting next week with QE2, and the question is it going to be as bad as everybody thinks? And I got to say, when the expectations are so low, when you think things couldn't possibly get worse, okay, you got to have hope that that's not the case. So I'm guessing that we are going to see some quantitative easing. They couldn't just take it off the table, because they would lose the one little iota of credibility they still have, which is basically none, if they don't ease. But I expect we're going to see it a lot lower than people are thinking, okay, because if we get these numbers, then it could be back to dollar weakness, which could encourage all these interventions, and we could have a global melee going on here in the currency wars with everybody fighting everybody, and I don't think they want to see that happen. So perhaps I'm going to be thankful then that the Fed actually set the bar so low, made the situation look so bad that I have to be an optimist, because to think otherwise would really be would be despair. So that's kind of what I'm looking at. Although I got to tell you, I'm not an optimist. Okay, regardless of how low they set the bar, I still think they can do worse. So I'm going to stick to my guns, provided those powers that be haven't found a way to remove my proverbial ones just yet. So that's what I've got for today, folks. Good trading to all.
As always, be sure to check out the written blog at www.fxedu.com to get complete coverage of today's Forex market. If you would like to learn more about how to trade the Forex market from professionals like myself, be sure to check out our affordable Forex trading courses. And if you're already a seasoned professional or aspire to be one, ask us how we can help you achieve your Forex goals. Go to www.fxedu.com to get started today.